Here now for an exclusive interview. Steve Leisman is joined by Dallas Fed President Robert Kaplan. A pleasure to have you both here. Steve?
Kelly, thank you very much. And Robert Kaplan, Dallas Fed President, thanks for joining us. I think the best thing to do is start exactly where Kelly instructed us to begin. It's best not to get on her cross-eyed there. Let me ask you about the inflation report this morning. Did you see moderation in it? Does it support the notion of inflation being transitory, or do you see more persistence in the number?
Yeah, so the outlook, the CPI number today was probably consistent with our outlook, which we're still expecting a year-end PCE to be in the year about 3.8%. We're expecting some of these extreme moves, used cars, other items to moderate, but we're still expecting a broadening of inflation pressures heading into next year. And our forecast for PCE inflation next year is in the neighborhood of 2.5%. So I think this report's basically consistent with that outlook.
Is that too high? Are you willing to abide 2.5% inflation?
The issue is if we have an extended period of time, this is my view, where you're running at 2.5% or a little above, our job at the Fed is to anchor inflation at 2%. And so I think we're going to have to be attentive to whether we see prospects that this excess over 2% is going to run for some time but moderate back down to 2, or whether this is going to be more persistent. And at this point, I don't know the answer to that, and I think we have to have a balanced approach and be prepared to react depending on how this unfolds.
Robert, the strong jobs report in July, or for July, means we did about 2 million jobs over the past 2 months. It seems like that part of the mandate is going okay. I want to turn now to your views on asset purchases and policy more broadly. Last time you spoke publicly, you said you were in favor of tapering soon, and sooner rather than later. Are you ready at this point? Do you have in your mind a timetable for that tapering?
It would be my view that if the economy unfolds between now and our September meeting, if it unfolds the way I expect, I would be in favor of announcing a plan at the September meeting and beginning tapering in October.
That's pretty aggressive. Would you say that's you have a lot of support on the board or the committee for that kind of idea, or is that just you? I don't know, from the Lone Star State.
I would say there's a range of views, and the main thing I've emphasized, whether we announce it in September or whether we announce it November 1st, I think there's a range of views. I just think the committee is in a much better place than we were 2 months ago, and that we'll debate, we'll disagree, we'll have to see how the economy unfolds. But the reason I'm saying we ought to begin the tapering soon is I think these purchases are very well equipped to stimulate demand. But we don't have a demand problem in the economy. We've got plenty of demand. Our issue is supply. And these purchases are not very well equipped to deal with that issue. They were appropriate in 2020. They were appropriate in early 21. And so my thought is I'd rather take the foot off the accelerator soon and reduce the RPMs and as we're on more level terrain. And I think it will give us more flexibility down the road to have patience on the Fed funds rate. But what I don't want to do is keep running at this speed for too long, and then we're going to have to take more aggressive action down the road. So I'd rather begin this process soon, and I would like to taper once we start gradually. And for me, gradual means over approximately 8 months.
Over approximately 8 months. It's Kelly here, and I appreciate you letting me jump in. I've actually so many questions, as Steve probably can imagine, after hearing your comments here for the last few moments. I suppose then the main one I actually want to ask you right now is about bond yields, President Kaplan. So why do you think they're down at 1.35%? Do you think they hold any economic information at this point? Are they being distorted by the Fed itself? I hear everything that you're saying, and it all makes sense to me, except that. And the people who are now arguing that inflation has peaked are saying bond yields knew this months ago. They've already figured it out.
Yeah, I do think the bond market is looking through these high inflation prints, and they're expecting the Fed to do what it needs to do to anchor inflation at 2%. In addition, there is an enormous amount of liquidity globally and in the United States. We're an aging society. There's an enormous amount of money in pension funds, and there's a very strong bid for the 10-year Treasury. And in addition, after we get over the horizon from this rebound from the pandemic, workforce growth is decelerating in the United States due to aging. Productivity doesn't appear to be strong enough to offset it. And if that's true, out-year growth looks sluggish, not just in the United States, but globally. And so I think all those factors are feeding in to where you see the 10-year Treasury.
President Kaplan, I want to continue the discussion on monetary policy, which is really related to what Kelly was talking about. You began and made a couple comments there about interest rates. Can you walk us through the sequencing in your mind? You talked about an 8-month taper. I didn't do the math, but I think if I add 2 months and 6 months, it brings me to June. I just did that live on national television. Are you thinking that interest rate hikes begin immediately thereafter?
So I am explicitly saying, and I've been saying publicly, I am divorcing my decision-making on adjusting purchases for my views on the Fed funds rate. And so I don't want to tie them together. There's different metrics and a different set of criteria I'll look at in deciding whether or not to raise the Fed funds rate. What I'm saying is these purchases are not well suited to the environment we're in now. And like a doctor who's prescribing medication to a patient that's been through a trauma, if you start to see side effects and you don't think the medication is very effective, and the side effects I'm talking about, excess risk-taking, elevated home prices, excesses and imbalances in the economy, I think the best thing to do is early begin weaning off that medication. And I think by doing that, we actually may be able to be more patient down the road on the Fed funds rate. But I do not want to tie the two together. It is not the primary factor that I'm thinking about in calling for adjusting purchases soon.
I get that, President Kaplan, but one of the distinguishing features of your background being on the committee is that you were an investor and on Wall Street for a while and know a little bit about this and how some of your former brethren on the street think. And they're going to think, hey, Kaplan wants to get rid of the asset purchases, and that clears the way for raising interest rates. Maybe tell us what your criteria are for raising rates and whether or not that's something you think would happen in 2022 or 2023. Thank you.
So as a former observer of the Fed, I think as and a market participant myself for a long time, if the Fed says that these are two different decision criteria, as a market participant, I would listen to that. And I do believe that. And so that's why I'm saying it. As you know, in my SEP submission, Summary of Economic Projections in June, my first rate increase is in 2022, but that's not a decision I'm making right now. That's just a forecast. I'll make that decision as the economy evolves into 2022. I am saying there's a near-term decision, and I think the sooner we make that decision, I believe we're going to have more flexibility, if necessary, to be patient on the Fed funds rate. And yeah, I think as a market participant, I think that logic is worth listening to.
President Kaplan, it's Kelly here, and just one more to kind of dig into your explanation of why we don't need to continue the pace of asset purchases. In other words, if you say we have a supply, not a demand issue in the economy, can you explain how the labor force supply ties into that? So if we have people who have left the labor force for early retirements because they have work from home flexibility, maybe allows them to live somewhere differently, lower cost of living, only one person has to work and so forth. Can you tell us what you're seeing in terms of those quote unquote dropouts and how that affects the supply side and overall the sort of fundamental strength of the economy?
So there's two types of supply issues. One is materials, semiconductors, a broad range of supply-demand issues for materials, and the Delta variant may actually make those more prolonged because they affect the ability to produce and to produce globally. And I think what contacts are telling me is semiconductor shortages, for example, are likely, in their view, to persist longer than people might be expecting. And the demand for semiconductors is increasing while the industry is trying to increase supply. So one person described it as trying to go up a down escalator. We're trying to increase production as fast as we can, but demand is also increasing. So that's one set of issues. The second set of issues is labor. And as you pointed out, we think at the Dallas Fed, there's been approximately 3 million retirements since February of 2020. Many of those people may not come back into the labor force. And then there's been 1.25 million to 1.5 million people who are caregivers, mainly working mothers, who have left the workforce. I'm hopeful that with expanded daycare, schools reopening in person, some percentage of them will come back. But the point is, the labor force is tighter than the headline statistics indicate. The number of job openings in the United States is at a record. Quits rate is historically high. And so all that tells me these supply-demand imbalances are likely to go on for an extended period of time, but they don't have to do with demand. They have to do, they're going to create supply issues. And so these purchases are not terribly well equipped to deal with those issues. And I think it'd be healthy for us to recognize that.
President Kaplan, to an extraordinary degree, and I've been covering the Fed for a very long time, Chair Powell and other members of the committee, such as yourself, have talked a lot about how the importance of what the Fed does for average Americans. But today, the government reported real earnings. When it reports CPI and inflation, it says how much wage gains have been deflated by inflation that's out there. And they're negative now for, I believe, the 4th straight month. How does the Fed step up and argue that it's now doing right by average Americans and average American workers when, in fact, the inflation that it's abiding is eroding wage gains?
Yeah, so I spent a lot of time, as you know, in low, moderate income communities in my district. And what I see time and time again in my conversations, people in those communities are reminding me our mandate is full employment, but it's also price stability. And the share of wallet, as you just pointed out, that low, moderate income communities are spending on gasoline, cars, other items, it is creating challenges for them to make ends meet. This is, again, back to our purchases. This is one of the reasons why I would prefer, from a risk management point of view, to ease off the accelerator and reduce the RPMs on what we're doing, because I think these imbalances, we're going to have to be patient and allow them to unfold. But I think anchoring inflation at 2%, I take that very seriously. It's a critical part of our mandate. Inclusive growth, inclusive prosperity is not just jobs, it's also price stability.
And we'll leave it there. President Kaplan, thank you so much for all of your thoughts on this today. It's great to have you with us. And Steve, we really appreciate you for bringing us that interview, doing a great job with it, our Steve Leisman.